Good evening, class. Professor York here. I want to go over some content that we covered today that we didn't really get a chance to really delve into in detail. As you know, we had our EIR, Matt Fay, in, and he gave some wonderful insights. However, I think that there's some gaps that I'd like to fill in, and so I want to take the next 20 to 30 minutes to do that. This way we save time for Monday for team time and to be able to progress into talking about the value proposition canvas. So two things we're going to cover: revenue and market models, and a little bit about cost structure. I think we covered this already in terms of the canvas. The canvas is going to drive a lot of things. We will get in more detail. I think the take home here is value creation, extraction will create revenue, and that how we manage our business from an operational standpoint and how efficient will drive our cost structure. And these will be two pieces that we will talk to in more detail through this lecture and throughout this course. So let's talk about revenue, market, and market models. Okay, so what's a revenue model? And we've talked about this, so if you want to fast forward to the cost side, get a little more detail, that's fine. But, the key is basically how our company captures value from our customers in exchange for the value proposition. As I mentioned, it's how you monetize. This can take in different forms and involves a variety of drivers. So the questions that you should be considering in developing a market or a revenue model is, what value customers are willing to pay for what they do pay, how they're currently paying, how would they prefer to pay, and how much does each revenue stream, we're talking about multiple revenue streams in some models, contribute to the overall revenues of a company. So let's talk about monetization. Okay, we went through this. So selling an asset, which is the ownership rights to a physical property, house, auto, company, usage being fee for service like a hotel night, subscription being continuous access service. We see this with a lot of online products such as, let's say, the best is Adobe now. We can do with Adobe. There are other things which you have. LinkedIn has a monthly subscription, but generally it tends to be software in nature. Netflix is another one. Lending, renting, leasing, that's your room rental or car lease. Then licensing, which is for the intellectual property, which is a licensing fee, which could be copyright permissions or patent licensing. And then a few more. If you're in real estate, you look for commission that comes when you put together a deal. Advertising is that revenue for the advertising, which is paying for space or the ads, or for SEO and hosting an ad, but also in terms of AdWords. Multi-site is when we get two sides of a revenue model where we have a free side or freemium, but we have some paying, who's paying for ad or paying for data. And then tiered membership, which is like in LinkedIn, where you may have free, but then you can expand out to more services, more capabilities on a monthly subscription. LinkedIn is a very good example. What is a revenue driver? We talked about this. And you have to start thinking about revenue as being driven by several components. The customer being first and foremost that's coming through. You want to service that customer, but also in terms of how frequent that customer is coming through. And then also in terms of number of units per each customer that occurs with each transaction. So those things become a base, and then the price per unit. You will hear other concepts, as Matt Fay talked about, in terms of market share penetration. You will also hear about velocity, which deals with the speed of which you can be able to turn a product through a company. But right now, I think the key is these are some basics. Just get back to, customers, units per customer, frequency of purchasing, price per unit. And, if you want to put on a monthly time period, you can do that. In some markets, we talk about market share, but this is I think the most basic way to look at it. Along those lines, we need to think about the customer and our market size. And you may have, like in the auto industry, you may have total addressable market, which is all auto, large university of potential users. Then you get the serviceable available, which may be, buyers or customers of cars, and then a serviceable attainable market, which might be, I want electronic cars. So you might be into the Volt, you may be into the Prius, or you might be into Elon Musk's company, Tesla. Okay, so that may be a much smaller market. So this is important because you need to know the number of customers coming in, so you can say share of that target market, the number of customers, which is going to drive that first piece, which is customers. Then there's different pricing schemes that we talked about. There's an actual list. You may have feature-based priced. You may have a segment-based where, depending on which segment you are, like in hospital business or healthcare business, hospitals may pay one price, whereas outpatient may pay another. Volume based on discounts, negotiation, which has been negotiated between two partners, depending on skills. We see this in terms of acquisition of companies. It can be in terms of acquisition of real estate. Yield management, which depends on inventory and time of purchase, e.g. seasonality. So products that are very popular at holiday time periods may be at a higher timepiece, or a piece of real estate, for instance, by the beach may be more valuable during the summertime in terms of renting versus the wintertime, or vice versa. If you are in the mountains and by a ski area, you might find that your property is more valuable then. Real-time market is when we're talking about the price being established by supply and demand. Stock market, real estate markets are good. Auctions, price determined by outcome of bidding, as you know, real-time auction, or we can look at eBay. So why do you create a financial model? This is Matt's slide, but basically is you want to model business over time and tie it to the business strategy plan. And it's hand-in-hand with decision making, both short and long term, and includes assumptions. And not to get in detail, but you start looking at sensitivity and scenario analysis. Basically, to boil that down is best case, worst case, and most likely case. And what you're trying to do is you're trying to track cash coming in to anticipate financing needs. And in particular is in the financial model, you're looking at the revenue side of the equation. And this is important because you're going to attract investors because they want to know, rates of return. And I'm not going to go into the details until later on. But they want to know if they're going to invest, are they in a lifestyle business, which may be $5-10 million, or are they on something that really will scale and grow, and that if they put the money in the bank, that this would still be a better investment than the return they would get getting in the bank. It's an ongoing process, and it evolves, okay, to reflect what's going on in the current situation. Matt talked about top-down and bottoms-up. Top-down addresses addressable market. It estimates the portion market that can be captured, as we talked about TAM, SAM, SOM. And, the example that Matt Fay talked about was the high protein frozen yogurt, which is a high-end market, which combined several different markets that were there. Still, at the end of the day, you're going to have to dial in and be more specific in terms of where the customer market is. Bottoms up starts with the actual product line or customer segment, from the customers down, up, and building up their revenue based on certain assumptions, as you saw in his model, going down to the store level. I think the bottom line about bottoms up is it gives you a more realistic assumption of the data, and it's much more accurate. It's a little bit more work, and it's easier to compare assumptions versus actual performance. I like to boil it when I do top down, bottom up through, is that you have sources, and we'll talk about doing market research, secondary market research, but you're going to use industry and market reports. You can use competitor press releases, university library, and investor and customer discussions. From the bottoms up, you're going to be using epidemiologic information, user trends. You may even use adjacent markets that customers might switch from, or proxy markets, and analysis and conversions to pull together the market size. So there are some differences relative to the top down, which tends to get from, I'm going to say, more secondary resources that you can sort of model against what you see that's been published, versus bottoms up, you're trying to get actually more real-time data. This is just an example. I don't want you to get intimidated by the spreadsheets, but I'll boil it down very simple. As we talked about drivers, this is bottoms up, and I have 4 drivers in the cancer chemotherapy space for metastatic breast cancer, and to model that market. And what we did was 7 different chemotherapy regimens. So we had the price of the regimen, how much that regimen used on an annual basis, what would share in the overall market, and the number of patients. So those pieces, as you can see in the market model, and as you can see, my model is a little simpler than Matt's. Is we take price, market share of the patients that we have, and give an estimate of patients that are there, and based on the price and the share, we're able to get an estimated cost or wholesale acquisition cost, and that's for naive, which means patients who had the cancer and got treated for the first time, but you have to add that to patients who are being retreated, which is the recurrent marketplace, and using similar drivers that are there. Okay, so you got to get good with Excel. Top down, you might do market sizing based on some reports. Here's some reports that I pulled up for virtual reality, which is a growing market, as well as personalized medicine, which is also a growing market in the healthcare space, as we look at both diagnostics and also therapeutics that are personalized to our genetic fingerprint. And here's just a model that we had created, and this was actually from secondary data. We did this for a startup that I'm getting back involved with called Vitria Pharma, in the retinal business, which is actually one of the more successful and larger markets in the ophthalmic space. And it was looking at neovascular indications. Don't have to worry about the science behind it. What I wanted to outline here is the TAM, SAM, SOM, as you can see, as we carve down in terms of total markets down to obtainable markets for the different indications. And this helps us make decisions on very important strategic decisions as to whether we want to go to a very, very large market, like in the diabetic retinopathy market, which is very attractive for investors. And if you're doing things from a drug development standpoint, that's going to take a little bit more time than if you went in very competitive marketplace versus corneal neovascularization, which is actually a little more blue ocean, as we talked about previously, where there's more opportunity, smaller market, and then even a smaller market, which is a rare disease market called neovascular glaucoma space. And what's interesting is the FDA looks at under 200,000 patients as being a rare disease, an orphan disease, and will give you fast track designation. So you can make some strategic choices in terms of, as you develop a product, based on your market size, either get a large market or a small market, depending on what your strategic position is that you're going to take. Okay, now we're on to cost. Um, I asked this question, cost structure, and I gave you those definition, cost involved with running our operation, which is that left side of the canvas. Okay, in terms of engaging our customers and delivering our value proposition. There are four pieces we'll talk about: components, value model, economies of, and evaluation. We already talked a little bit about components, but before we go into that, I want to talk about questions. And I think that you always have to ask a lot of questions. So you need to be asking this question: what type of business model are the key activities and resources, which we know is the left-hand side of the model? Is it in-house, or do we outsource to partners, such as in your supply chain? And when should I take advantage of that supply chain or the partners? Do I own or do I lease? A good example is when we were talking with Zoe about the refrigerator. You can actually own, which becomes a capital piece of equipment, which is a fixed cost, or you could lease it. Same thing with in terms of property. You can lease or you can own. And as a result, it can be a fixed or variable cost that's there, but can really influence your overall cost structure and even your financial model on the cost side relative to, do I take it as a depreciation cost or do I just take it as a straight write-off? And that's where we get to depreciation. Where does depreciation make sense? And that's in hard assets, such as physical assets, such as property, such as, building, equipment, okay, automobiles, trucks, which you can write off 5 to 7 years, or do you lease it? And then you have to ask the question, which we'll get later on: what's break even? What's the net present value on that investment? What's the advantage of scaling and expanding scope? And do you have burn rate? These are things I'll come back to in a little bit. And, I think as Matt talked about, what's our cash on hand at the end of the quarter? Because, you got 15 days to pay people. You got to run that operation. And, I think an interesting question is, how much of that cash is driven by revenues versus your investors, which is important because you want it to be driven by revenues, which makes for a healthier business than have to depend on investors consistently. And how much of an impact are the expenses upon the burn rate and cash on hand? And this is very important in terms of how frugal. Good example is a company I heard on Warden's business channel just last week. They are called Kindred, and they run a very lean model, and they joked about staying at Holiday Inn in New York City and taking connection flights that go from New York City to San Francisco because they need to watch their cash. So I think that's an important thing as you run your business, is you have to think about that because you need to make sure that your cash, especially as you're not bringing in revenues, that your cash is being able to sustain the business, because it's one of the key reasons why business fails. So 2 core components. This will be on every business model canvas. Fixed remains the same despite volume of goods or service. Could be large upfront costs, especially capital intensive. Think about that refrigerator. Think about that building. Think about that truck. Okay. Think about that IT backbone. You can even think about salaries, because salaries are not going to vary pretty much. Like if you're a restaurant, you hire a person. That person's going to be there for X period. Number of people going to come through, whether it's 2 people or 10 people. It's pretty fixed. Variable is something that varies in proportion of goods and services, and that's like your cost of goods. It'll be there, and a high degree of customization and personalization of the services that are there. So, consulting work. And I'll use the example that Matt brought out relative to his labor actually being a variable cost, because that was a part of cost of goods and delivering services to the client, which he would bill out. and I do that in my own business as a consulting. So if we bill out X amount of time, and I have consultants doing that, I bill that into my piece. And that variable cost is something that bills directly, and it varies with what the workload is. It's not something I carry over time. So labor is one of those that can go both variable as well as being fixed, and it just depends on if you're part of producing the good. That's going to vary with volume, or even sometimes your sales costs can be a little bit variable with the volume that's there as you add extra salespeople. But your overhead costs, we call it sales and general administration, your R&D costs generally are fixed, and so therefore those fixed costs become more attractive as you scale and you have backbone that you can be able to amortize those fixed costs over time and over size. Okay, so let's talk about model and value model in terms of cost. So you can have a cost-driven model. Southwest, good example. You focus on minimizing costs wherever possible. You want to create and maintain the leanest organization possible and cost structure. Kindred's a very good example. This company that does drug development up in the Bay Area. Generic drug companies do this as well. And what you look at, low price value propositions that maximize automation and extensive outsourcing. And I mentioned about Southwest. Value driven on the other side is going to be on creating value, high degree of customization, personalized service, luxury hotels, Orange County Choppers, McKinsey Consulting, that are some examples that are there. And then you have what we call economies of scale and scope. Scale being we're taking care of cost advantage with larger output, so cost per unit decreases with increased output. That's the advantage of scale. And it argues for those fixed investments in equipment and mass market approaches, or having a good IT infrastructure. Amazon, very good example, heavy upfront investment into that IT infrastructure and into warehousing, etc. But now as they scale out, it shows that with the economy of scale and the backbone that is there, that actually it's more cost effective. So as a result, when you have that, as you scale, you actually are able to sell products at a lower price. So, the best example is the Model T with Ford as an example. On the other side is scope, which is a cost advantage on having a larger scope of operations, use the same marketing, manufacturing, and distribution, to cover multiple products. And I love the concept of the wonderful company out of LA, which bought Justin Wines, and which also has, Halos, in terms of tangerines. They also have Palm Wonderful, and they have Fuji Water. InBev, for instance, is a large international, I'm going to say, beer alcohol distribution business, buys Firestone to fit into its portfolio. InBev, by the way, owns Budweiser. So broadening its scope, because the power of these organizations is that they have distribution, so they can, because they dominate the distribution channels, they can be able to push a wider variety of products across that because of the established relationships that are there. So one of the concepts I do want to reinforce from our class today that Matt had touched into was just the income statement. I know he got very detailed, but let me just boil it down to. So you got sales, and everybody thinks, okay, sales is it. But realize you're going to have discounts, you're going to have returns, you're going to have things that are going to come up and going to nip your sale number. And basically, after discounts, which do happen, you get what we call top line revenues. Okay, so that revenue number is a nice number, and the street likes to see that, but it's not profit. because there are things that go into it, such as the cost of goods sold. So there's people that are working on to do the lawnmower business, or staff for manufacturing, or the base supply for manufacturing good, or you could go take it even further in terms of fixed costs, such as the machinery that would be for the landscaping business, or even the factory, that are amortized and how it's used. Those are fixed costs that are there. And the difference between the top line and the cost of goods create what we call gross income. It doesn't stop there. We also have what we call general overhead, or you'll hear the term SG&A, which is really sales and general administration. Maybe they'll throw in R&D if you have an R&D intensive organization. And again, these will be fixed and variable, especially the sales side, and the marketing costs will vary with volume and size. But generally, these are fixed costs in terms of, because their headcount and their operation and their backbone, like IT specific, that's there. So when you subtract that out, you get net income. Now there's a little thing called depreciation that Matt didn't get into, but you do get a tax benefit when you buy a piece of capital equipment, or you invest into a plant or new offices or whatnot. We're seeing a lot of money, like you may have probably heard about Apple wanting to spend some gargantuan number of billions of dollars back in the U.S. building, manufacturing capabilities. So what you can do with equipment and with property is you can depreciate it. And you can depreciate it, depending on the schedule, anywhere 5, 7, 8 years. That gives you, against your taxes, a write-off. And what it does is it comes back to your income statement as a positive additional free cash flow, which gives you EBITDA, which Matt had talked about, which is earnings before income taxes. Okay, so those are something that you may want to think about, okay, when you are doing your model for revenues versus costs that are there. And it's important because you start thinking about the financial standpoint, because your investors are going to think about return on costs. One of the concepts that's a pretty straightforward concept is called just break even. Okay, and that is, again, looking at your fixed costs divided by your variable unit price versus your variable unit cost. That would basically be your margin. Okay, and your variable unit cost, okay, can be not just the production costs, but also the sales and marketing costs as well. So that can give you like the number of units that you'll get to break even, which is very important. And then there's another concept that is called NPV. It's a popular term with those who are in the MBA curricula. But basically NPV is net present value, and the boil it down is $1 today is more valuable than $1 a year from now. You could take $1 a day, put it in the bank, and you still would get interest, and it'll be a year from now more valuable than using it. So it's the time value of money, and we look at the initial investment versus future cash flows. So we had talked about that income statement, and out of the EBITDA, which is basically your cash flows that are there, you look at how those net out off your investment on, I wish to invest in a marketing program. Okay, so you may spend a few $1 million. You need to look at your cash flows, your revenues, and then ultimately your cash flows that generate off those revenues, to see whether it pays for it based off discounting, which I do think I do have here, just with discounted cash flow, because there has to be a factor to discount the future value back to today's value. And by taking those future cash flows and discounting them back down and comparing them versus that initial investment, you get a concept called net present value, which tells you whether I should just put the money in the bank or not. And if it's positive, then that's a real good go forward sign. If it's negative, it's a big red flag. And there's some discussions in terms of the pros and cons of moving forward with that investment in that initiative. This is done with capital equipment. It's done with IT infrastructure. It's done with marketing programs. Any type of thing that comes up, and especially at senior level, if you're making a business case, you really need to use a net present value, and there's another concept called the internal rate of return. I want to boil this back down and bring it back to a concept that we will talk about a little later on, but is very, very important, which is used commonly in the entrepreneurship world, which is the funnel metrics. And in the funnel, we have get, keep, and grow, which is get, which is customer acquisition, keep, which is holding those customers, and grow, which is expanding and either getting what we call viral growth from word of mouth or recommendations, or upscaling in terms of how we grow those customers in terms of cross-selling, upselling. But in terms of the key metrics that we need to think about, a very most important metric is the cost to acquire or activate a customer, which is those total costs that you invest in your marketing programs to drive one customer from being aware to ultimately purchasing that product. And then ultimately, the second thing is, which is I think a critical cost metric, which is the lifetime value of that customer. So once you have that customer, especially if you have a product that is a recurrent purchase, is you don't think about that one-time purchase. You think about over multiple years, 3, 4, 5 years, in terms of how much revenue you can get from that. So that repeat is very, very critical. So critical cost metric, which is that net of that lifetime value of the customer and the cost to activate the customer. So I think those are two very simple funnel metrics that you need to think about in the financial side. And as you pitch your business, you are going to have questions about that CTCA and the LTV. Matt talked about this in terms of cash burn, which is really the rate of expenses less revenues on a monthly basis, and the cash remaining at the end of the quarter, the number of months the company has to sustain operations based on the present cash and burn rate. And what we have on the right hand side, as you can see here, is basically your revenues that are coming in. You see your gross sales, and then you see your net sales, which would be in terms of after discounts, as we talked about previously. And then you get into some of your fixed costs that are there, and what you're trying to do, and operating costs, which is sort of your mix of your SG&A. And I hate this actual spreadsheet because it doesn't fully represent what we call a true income statement. But what I do like is the burn rate. Okay, so you're taking your costs against your revenues, and then what you're doing is looking at your burn rate. You're looking at also is what you have in the bank, because you can, based on what your investors in, and you can go with your burn versus what's in the bank, and you look over a quarterly basis to see if you can sustain. And one of the things that is calculated out based on what cash is in the bank and what your burn rate is how much time do you have left to operate? Is it 15 days? Is it a month? Is it longer? And this is very critical in running your business and articulating what your investment needs are going to be, or what you need to do in terms of managing your cost structure, which is very, very critical so that you can be able to maintain your business, because what happens and kills a lot of business is just running out of cash. So anyway, here we are at the end. Hopefully this wasn't painful. It fills some gaps, and I think that the take-home message here is that the lifeblood of a business, whether it's a large business, small business, is its financial state. Remember, 82% of small businesses start to fail because poor cash flow, and that's from U.S. Bank. So to stay afloat, you need to make sure your revenues exceed your costs. That's number one. That would be ideal. And if not, you better have some very patient investors, because investors are very attuned to the day they put their money in and the day that they get it out, and that they're getting multiples, and usually multiples are 10x. So it's like owning a boat. The best days are the first and last day. And if you don't have that, you better have a very, very rich uncle who can be able to supplement your cash. And we call them part of the 3 F's: your friends, your family, and your fools that are there. But as a good business person, I would also focus in on making sure that you're building a really valuable product that's in tune with your customers. And you have a business model that can be able to capture that value. So you have that you can make sure those revenues are greater than costs. And on the flip side is really be very aware of your costs. And I really like the example from the folks that were at Kindred, who are ex-pharmaceutical folks who could spend a lot of money. These people are independent and wealthy, and they said, hey, we're trying to stay at real cheap places. We're trying to use, connection flights, etc. We're developing drugs for animals that are $2 to $5 million rather than humans, which can be up to $1 billion. We realize our returns are not going to be as great, but we know that our return on investment, if I can get $50 million of annual sales on a product that I can get out in the market in 3 years, I'm going to have a pretty good return on investment. So I think that's important as you look at business. You have to think through the financial pieces. So hopefully from the discussion we had with Matt today, that was helpful. And hopefully this little video here has helped really put it together. And then as we go into the business model canvas, it'll help you think through the business model canvas a little bit more from a financial standpoint, because at the end of the day, I hate to say it's about the dollar sign, but it is about the dollar side, whether you are a for-profit company or you're a non-profit company. Anyway, have a great evening. I'm going to sign off now. I'll see you on Monday, and enjoy this video, and we can get into some fun stuff next week. Bye.